This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and have a look at the chapter on intangible assets. We've gone through and looked at everything to do with your tangibles, haven't we? We've gone through there and seen how to account for property, plant and equipment with the basics with regards to PPE and IAS 16. We then advanced it on, didn't we, with those three extra little standards. So there was one there to do with government grants. There was also one to do with borrowing costs, wasn't there? And there was also one there as well to do with investment property. Okay, any one of those could make a really good, couldn't they, objective test question within the exam. Okay, now we're going to just advance it further, still sticking with that non-current asset aspect, but we're going to look at intangible assets. And the key thing that we have about your intangible assets is that they have no physical substance. So it's something there that you can't physically touch. Okay, everything that we saw with PPE, land and buildings, plant and machinery, motor vehicles, fixtures and fittings, all of those you could physically touch, couldn't you? Okay, they had a physical presence. Here, intangibles, they have no physical substance whatsoever. If we extend the definition a little bit further in terms of what we see within the accounting standard IAS 38, is that first of all, it needs to be identifiable. So we'll touch upon that a little bit later, but you can see there at the bottom, you can actually sell that intangible separately. Okay, so you can sell it by itself without anything attached to it. Also, as well as it being identifiable, no physical substance, it needs to be non-monetary. Okay, now with non-monetary, we're saying there that is not readily convertible into cash. If you think about a receivable or you think about a payable, that can be readily converted into cash, can't it? Your supplier could demand payment, you have to pay. You could ask your customer for cash payments, and they would have to pay you. Okay, but with an intangible, we don't aim to go through there and buy it and sell it. We aim to go through there, potentially buy it and use it within the business. Okay, so it's non-monetary. Okay, a little bit like inventory, a little bit like property, plant and equipment, isn't it? Okay, a couple of examples that you will see potentially within examples and within the real world. There are an enormous amount of intangibles out there. We're just going to touch upon a few. What you have here, first of all, is a patent. Any of you know what a patent is? Come across it before within the real world? No. Have any of you got your own patents? No. Well, if ever you come up with an ingenious idea, okay, you create a little bit of technology that you want nobody else in the world to copy because you think it's going to change the world. Okay, if that's the case, you take out a patent. Yeah, you go to the patents office, you register your idea, and then nobody else can copy that idea. Okay, I think there's been legal wranglings in the past between Samsung and Apple, each one claiming that it had the patent over a particular type of technology, whether that's touchscreen technology on your tablets, the use of apps, whatever it may be. But they left that to the courts to decide who came up with the idea. Again, another one that you may be familiar with, particularly if you're in the UK, we have an inventor by the name of Dyson. Dyson invented the bagless vacuum cleaner, a bit of groundbreaking technology, and they filed lots of patents when they came up with the idea to prevent anybody else copying them for a period of time. Okay. Other one is a brand name. I think you know what we mean by brand names. Nike, Adidas, McDonald's, Kentucky Fried Chicken, to quote a few. They are all brand names, aren't they? Okay. They're identifiable. You can't really sell them separately, can you, with regards to the brand name without selling the entire business. It's non-monetary. So, it's not readily convertible into cash, is it? And there's no physical substance, is it? It says Adidas on your shirts, and you've got the three stripes and the logo at the side. There's no physical substance to it, is there? Okay, it's just something that exists. Then you have a license. A license essentially is whereby you buy the right to use something for a period of time. So maybe you are a publishing company and you have bought the rights to print the Harry Potter series of books. Okay, that would be quite lucrative, wouldn't it? Okay, it's identifiable. You can sell it separately, can't you? You can sell that license to somebody else. Non-monetary, it's not readily convertible into cash. You'd have to locate a buyer, which may take a while, possibly not so long if you had the rights to distribute the Harry Potter material. But let's not worry about that. And again, there's no physical substance, is it? Okay. So what we do is you take things a little bit further in terms of the identifiability, the assets, and how it all fits together. Because there's three factors to go through and consider. First one, as I've said, is it has to be identifiable. So as we will see later on, a brand name, although it is like an intangible, we can't actually recognize it as an intangible within our financial statements. For one reason, you cannot sell separately, and another, we'll come to it a little bit later on. Okay. Likewise, if you think about the definition of as an asset is a resource controlled by an entity, isn't it? So what you have to be able to do there is you have to be able to control the benefits that you get. So you essentially prevent others from getting those benefits, therefore entitling you to increase your economic benefits. So that's what happens with a patent, isn't it? You have control over the idea that you have created, or with a license, you have control over who can print the material. The third and final bit of the factors to consider, I would say, is looking at the recognition criteria. And the recognition criteria comes there from the framework, doesn't it? Okay. You can sense what's coming. What was the recognition criteria from the framework? Take a moment or two to think about it. We looked at it in one of the earlier chapters, didn't we? We said that we need to learn the definitions from the framework, the definitions of assets, definitions of liabilities, income, expenses, equity, I think was another one, wasn't it? And then, yes, it may have met the definition of the elements of the financial statement, but we can only recognize it providing it meets two criteria. What are they? Yep, that's a good one. Okay, got that one. One was that you can measure your cost reliably, wasn't it? Okay, excellent. And then the second one, yeah, fantastic, is it was all coming back to those economic benefits, wasn't it? And it was there looking at probable inflow of economic benefits. So that's a key component that we see. You know, the IAS 38 talks about identifiability and control of an asset, and then we bring that back to the framework and the recognition criteria. So it needs to meet the rules per IAS 38 as well as the rules, if you like, from the framework. Okay, so bear that in mind in any complex situation that you may get. I doubt that you will get anything too complex in terms of intangibles within the exam, but just bear that in mind. What we need to go through and do now is just start to think about things a little bit more specifically, and the three areas to look at with regards to intangibles. Okay, so the three scenarios, if you like, that could appear within the exam. The first one that you've got there, we talk about, is the separate acquisition of an intangible. So you buy a patent or you go through there and you buy a license. Okay, how do we treat that within the financial statements? Second one, it is sort of a combination because they are both closely linked. It is when you start to develop intangibles internally. So a lot of these large pharmaceutical companies are involved in research and development, aren't they? Okay, and the idea there is to produce knowledge that gives you the idea to be able to go through there and produce a new drug that will hopefully develop a cure for whatever illness or ailment it may be. Okay, so you know, how do we account for the research? A lot of money is spent on research, isn't it? Before it then becomes development, how do we then treat the development criteria, okay, or the development expenditure that we incur? Third and final bit is going through that and looking at your internally generated intangibles, which are not research or not development. Okay, so things such as brands, reputation, customer loyalty. How do we deal with that there? Okay. So separate acquisition, you purchase an intangible asset, whether that's a patent, whether that is a license. It pretty much follows the accounting treatment that you have from property, plant and equipment in terms of your initial recognition, because all you go through there and do is that you capitalize it at cost. So again, you've got your purchase price, import duties. It's unlikely you'll tend to import patents and licenses, but just in case, and non-refundable purchase taxes, less any trade discounts. Okay, again, unlikely to get any trade discounts, but you get the idea. Okay, again, don't forget there, you then add on any directly attributable costs. I think one of the key aspects that you've got there are your legal fees. If you take out a patent, it's very cheap to buy a patent at the patents office, but it's very expensive to get the solicitors in and a legal team to ensure that the document provided is watertight. Okay, there's no leakage in it that prevents people copying your idea through some form of loophole that's been left out of the document. Okay, so yeah, the legal fees tend to make that intangible very, very, very valuable. Okay, so that's your initial recognition. Subsequently, we'll keep it nice and simple. You know, PPE, we charge depreciation on it. Here on an intangible, same principle of matching the benefit of the asset to the cost of using the asset, but we refer to it as amortization. Okay, so it's exactly the same accounting treatment. You debit your amortization expense in profit or loss and credit your accumulated amortization on the statement of financial position. Again, that tends to be then spread over the useful life of the asset, because a lot of patents, a lot of licenses have, if you like, finite lives. And then again, it's ready to be amortized from when it is available for use, like on your depreciation, not when the asset is physically being used, but when it is available for use. Okay, excellent. There you go. Now, there'll be a couple of examples that you'll see within your revision kits that go through the separate acquisition. Okay. Second bit, R&D, research and development. So what's research? There is a dictionary definition of research contained within the standard. For me, that's scientists playing around for science's sake, in the hope and the prayer that you discover something. So it's getting a test tube with a liquid, another test tube with a liquid, hoping to discover something and just keep pouring one into the other. Okay. Does anything happen? No. Okay. So therefore, it's unlikely that you're going to get probable future economic benefits, isn't it? Okay, we can measure the cost reliably. Okay, we know what we're expending, but we don't know that we're going to get any benefits from it, do we? We're just playing around for science's sake. Okay, if that's the case, then any research expenditure goes immediately to profit or loss as it is incurred. And once it's expense, that is it. You cannot go through subsequently and capitalize it. Once it's written off, boom, that's it, never to be seen again. Okay, so what you want to do is you want to try and get that research phase into development, because when we go through there and look at development must be capitalized, and I emphasize the word must because in days gone by in the past you had a choice whether to capitalize it or not. But now, to ensure comparability between pharmaceutical companies, they all have to capitalize development expenditure. What is development expenditure, or what is development? Development is when you get the test tubes with the liquids in, pour one into the other, and all of a sudden there's a fizzy pop. And it's like, oh, I know what I can do now. I can use that, and I can develop a cure for some disease that's been problematic for centuries. Okay. So any expenditure you then incur going forward on developing it into a finished product must get capitalized. However, there need to be set criteria, because remember, it's not prudent to recognize an asset, is it? So we want to be very prudent and make sure that there are stringent criteria to make sure that things are capitalized as and when they should be capitalized, not so that people can try and capitalize expenditure when they shouldn't, thus creating, if you like, a bit of an ethical issue, isn't there? Okay, people might try to capitalize expenditure when it's still really research, but they claim that it is development. Okay, so what you've got is you've got 6 criteria. What I would do is I would learn them. We'll come up with a way of learning them in a moment because it looks quite tricky. But the key bit is what you want with your development is you want to demonstrate categorically that you are going to get probable future economic benefits. Okay, that you're definitely going to go through and be able to take this bit of development and convert it into a final product and be able to sell it. Okay, so what you've got there in terms of the actual criteria, you need to be able to sell the asset at the end, or your, maybe you will use it yourself. It needs to be commercially viable, so that there needs to be an actual end market for you to be able to put that product out there to be able to sell. Technically feasible, it's not some far-flung crazy idea that you have. It will work essentially, and you would need to be able to demonstrate that it is technically feasible. You have the resources to complete, so usually if you're a large pharmaceutical business, you will have those resources to complete it. So what you have there is that those four essentially are all to do with IAS 38. Okay, they are specific from IAS 38. The two at the bottom essentially are the ones that come from the framework. You need to be able to measure the cost reliably, and you need probable economic benefits, which, if you like, that's what the first four are going through and demonstrating. Okay. Ugh. How do we remember those? 6 of them. There's a cheeky little mnemonic that I've been taught over my years as an accounting tutor. Sometimes is a little bit too long, but there we go. So what you've got there, sector. Okay, sector. I think in some notes you might see the one pirate. It's like sector and pirate. They're very similar in terms of a lot of the letters, but it's up to you. If you see in the notes that you've got from whatever tuition providers, books you may have, then by all means stick with pirate. I prefer sector. Okay, because what you've got there, S stands for the fact that you are going to sell it. C is the fact that it is commercially viable. C is that it is technically feasible. R, you have the resources. And then the other two have just been cheated, really, to make up a word that we can remember. E and O, sector. Okay, because we want to measure the cost reliably, so that's thinking about the expenses. And then O, instead of probable, you want overall economic benefit. Yeah, no, it's a bit of a fudge, really, isn't it? But if you're there within the exam, sector should be something there to go through and help you out. Again, I think it could be one of those maybe drag and drops, or select all of the following, which are, if you like, development capitalization criteria. Okay, you'll be given some other ones, and then you'll be able to drag and drop into the correct place, or you need to select all which are correct. Okay, so just bear that in mind. Then what you've got right there, sandwich at the bottom, internally generated, really simple. Key bit there is that they cannot be capitalized. So if you spend money on your brand, okay, it's like, right, I've got my Nike brand, I'm going to spend billions of dollars on it, improving it. It's like, well, is that specific expenditure on the brand? Okay, but if you invest that money into the brand, it can then be sold separately. It's all a little bit of a fuzzy area, isn't it? So the key bit there is that the cost that you say you're spending on the brand is essentially just money being spent on improving the business overall, isn't it? And as it says there, the cost cannot be separated from the overall cost of developing the business. Okay, so it's not separable. It's not, if you like, then going to go through there and be specifically spent on that brand. It's like a general expense, so therefore we cannot capitalize it. If you're curious there as to what it means by mastheads, okay, it has nothing to do with a mast on a ship on the top of it whatsoever. A masthead is when you look at a newspaper, and you look at the newspaper, that's the Wall Street Journal or the Financial Times, that name at the top is the masthead, okay, and that is an intangible, isn't it? You know, it generates huge amounts of money for both of those papers, whether it's online or whether it's the hard copy version. There's no physical substance to the name, it's just a name that exists. It's non-monetary, it's not readily convertible into cash, is it? But the key bit there is that if you spend money on the brand, or spend money on the masthead by changing it, it's, you know, it's just expensed. Okay, it's no specific expenditure because you can't separate it out from the rest of the business. Okay, excellent. So just remember those scenarios there. In terms of what you got over the page, again, just bits and pieces to go through there and remember. Revaluations, PPE, remember we revalued it up to fair value. We depreciated that fair value over its remaining useful life. Essentially, intangibles, that they're never going to be revalued. And if they can, it's a very rare situation. And we only revalue them if there is an active market. Okay, active market, what does that mean? Essentially, an active market is where the items traded are homogeneous. Ugh, what a ridiculous word that is. I thought it was meant to be an international accounting standard. How many of you there out there in the world internationally away from the native English speakers know what the word homogeneous means? Yeah, speaking a bit of French, I don't know whether homogeneous is the same, but geez, I wouldn't have a clue. But homogeneous to you and I, to keep it simple, is identical. Okay, they are exactly the same. Okay. Likewise as well, you have buyers and sellers can be found at any time. So essentially, that there is a market that does exist, and then there the prices are available to the public. It's not a market that's restricted. It's a market that you and I could go through there and buy the intangible. Okay. Key one is I tend to think it is this one, the top one. The items are identical because it's very rare that you have identical intangibles. There are some that are out there, fish quotas, milk quotas. They are identical because it gives you a license to be able to fish in a particular area for a particular amount of fish. There's markets for it, and you and I, if you wanted to set up your own fish business, you could buy that license. Okay, but a lot of other things that you have cannot be revalued. Licenses can't be revalued because it's a specific license, isn't it, over a particular product. Okay, a patent is a specific patent over a specific idea. There's no other idea like it is. That's why you've taken out the patent, to protect your idea. So it's very rare that you can revalue your intangible. So make sure you learn the active market definition in case that appears in an objective test question. Just a little bit before we go through and start to get involved in the numbers and an example. Let's just talk about is it your amortization? So that's the equivalent of depreciation. We've spoken that you amortize the asset from when it is ready for use, not when it is physically being used. And what we mentioned earlier on was that if it had a finite life. So finite life, a set period of time that you get the benefits to that asset for, then you amortize it over that useful economic life, don't we? So if it's a 10-year patent or a 10-year license, boom, amortize it over 10 years straight line. Okay. Again, just note a residual value is normally taken to be 0 because there's unlikely to be an active market, is there? So residual value is 0, tiny little picky point, unless someone's agreed to buy it from you at the end of its life, okay, or there is an active market. But the one whereby someone's agreed to buy it, say after 10 years, that does give you evidence of a residual value, doesn't it? Okay. The other situation to be on the lookout, and we'll see this in the next chapter when we look at impairments, but if the asset has an indefinite life, so it lasts forever and ever and ever, so there is no finite period of time. Now, you can't amortize something over an indefinite period, can we? So if that's the case, then what you will do is you will look at an annual impairment review. And all an annual impairment review does is look to see whether or not the asset has fallen in value. If it has, we reduce it by the amount that which it is expected to have fallen by. How do we know how much it's fallen by? Next chapter. Okay, we'll go through there and see that within the next chapter. Okay, all there about impairment and IAS 36. Okay. Right to the moment you've all been waiting for, an example. We could have thrown a couple more examples in earlier, but I just think that there's plenty of stuff to go through there and get you stuck in within the real exam, within the revision kits. So what have you got? It says, explain the treatment of the above in GKS's financial statements. So SFP, profit or loss, is it there for the year ended the 31st of December 20X5? Okay. So I reckon it's going to be to do with intangibles. GKS is a large pharmaceutical business involved in research and development. So there we go. What's the accounting treatment of research? Excellent. Expense it through to profit or loss. Development expenditure. Yes, we must capitalise it, mustn't we? Don't worry, I'm not going to go through the 6 criteria. I can hear you shouting at me already. Sector, sector, sector. So yeah, great sector. What does it stand for? Yeah, that's a challenge, isn't it? Yeah, never mind sector. Tell me what it stands for. That's the hard bit, isn't it? But research and development of a viable new drug. Okay. It commenced initial investigation into the viability on the 1st of February 20x5. So investigation into the viability, playing around, isn't it, to see whether or not it's going to work. Investigation into the viability. What would you call that? Excellent. Research, ladies and gentlemen. That is research, isn't it? So the 1st of February X5, $40,000 per month. It will be expensed through profit or loss, won't it? Okay. On the 1st of August, is it the 20x5? GKS were able to demonstrate the commercial viability. Excellent. And intend to sell it. Okay. We are a large pharmaceutical business, so I would have thought we would have the resources. I would have thought we would have had the technical feasibility of this drug. Okay. And then what it says is that's essentially now development, isn't it? Okay. You know, it goes on in the next paragraph. As I say, the drug was not yet complete, but it's believed that by mid-26, the drug will be available for sale. So we do expect to go through there and sell it. Okay. So there is a market that demonstrates the commercial viability. So therefore, that now is, isn't it, from that date? Development, isn't it? So therefore, what we're going to go through and do is capitalize, isn't it? Okay, so we're going to capitalize how much? $40,000 per month. The cost does not change. Okay, it's the same previously to what it was now. And it says, you know, a little bit of extra information, I suppose. In December, it was not yet complete, so it is not ready for use. So therefore, we do not amortize it, do we? Okay. And likewise, it says the FD is confident of the success of the drug. He wishes to revalue the intangible using a discounted future cash flow model to establish the fair value. Can we revalue intangibles? Technically, we can, only if there is an active market. Is there an active market? Remember, it needs to be homogeneous. It needs to be identical. Well, if you're the only person developing it, surely there's nothing out there that is identical, is there? Okay, so if that's the case, we cannot revalue it, we cannot amortize it, but we need to expense an amount through profit or loss. We need to expense an amount, don't we? Is it there? Or capitalize, I should say, on the statement of financial position. So was it there the 1st of February X5 to, was it the 1st of August X5? Check on your fingers. February, March, April, May, June, July. Okay, don't go into August. So we have 6 months. 6 months at $40,000 per month is $240,000 that gets expensed through the statement of profit or loss, isn't it? Okay. Then from the 1st of August X5 through to the 31st of December X5, which I think is 5 months. Okay. Okay. So that's 5 months there at 40,000. That gives me $200,000 that we capitalize on the statement of financial position as an intangible non-current asset. Why? Because on the SFP, that's whereby now we have reached the development stage, whereby previously it was just research, wasn't it? Okay. And then when you're going through and thinking about the development, we mentioned, was it the criteria? Was it the sector? So remember, we're going to go through and sell it. We'll ignore the E. C is that it is commercially viable. Okay. T, remember was that it was technically feasible. I can hear you all shouting at me now. R is that you have the resources, isn't it? And then those last two there are the cheats, aren't they? In that you can measure it reliably. So that's looking, is it at the expenditure? And then O is probable, or your overall economic benefit. Okay, there we go. Again, just to add it in, so I've written it all in. There is no amortization, is there? Because it is not yet ready for use. And likewise as well, there is no revaluation because there is no active market, is there? Okay, there we go. Questions in the exam won't ask you what to explain, but I think it's good that we do that type of question to give you a thorough understanding of how it all works. I think in the exam you're likely to have to work out the carrying values of your intangibles based upon the cost, based upon the useful life. You might need to go through as well and work out the amount of costs that you capitalize as part of development and how much you expense as part of research. Okay. Just to go through, finish things off, I think there's a tiny little bit there, isn't there, right at the bottom. Intangibles and business combinations. Essentially, it's a little bit of a cheat, this really, because this is looking more at IFRS 3. And that's what we saw in our group. Oh, sorry, careful. It's what we'll see in our group accounts later on, isn't it? We haven't yet looked at that. So I won't talk about this too much. What I'll do is I'll refer back to it later on when we start to look at group accounts. But the key bit is that when you have here, it talks about business combinations. That's looking there at groups. Essentially what we have is that we have different rules for the intangibles. So essentially, when you buy a business, you get control of that business. There's new accounting treatment that we have to adopt, and the accounting treatment of your intangibles becomes ever so slightly different, particularly for those intangibles that were not previously recognized. So things that were expense, such as research, money spent on brands, money spent on mastheads, we might look to change that accounting treatment, but only when it comes to group accounts. So don't stress too much about it for now. We'll talk about it again a little bit later when we get into group accounts and how to look at it there. But other than that, there's not a huge amount on intangibles, is there? I think you'll all agree. But remember, think about your initial recognition, subsequent recognition. You can't go too far wrong within any exam question. Have a work through the materials and the questions again. Have a couple of practice on the revision kit questions. If you get stuck, we're still here. Okay, good luck and keep up the hard work.